The broadcast is now starting. All attendees are in listen-only mode.
Welcome, everyone. My name is Megan Cox, and I'm the Marketing Events Manager at Curinos. Thank you for joining us for today's webinar, Banking in 2026, Growing Profitability When the Market Won't Sit Still. As the industry's leading provider of data analytics and technologies, we're here to help you better attract, retain, and grow more profitable customer relationships for your financial institution. If you have any questions during the presentation, please type them into the question box in your GoToWebinar control panel. This webinar is being recorded, and we will send the recording to you via email post-webinar. Now I'd like to introduce our CEO, Sid Singh. Over to you, Sid.
Thank you, Megan, and warm welcome to all, and thank you for joining us for our 2025 year-end webinar. I'm Sid Singh, CEO of Curinos, and I'll be moderating today's conversation. Let me do a quick intro of the panel that we have. So we are joined today by 4 leaders who are shaping how banks compete in this new AI native era. First, really pleased to announce Dr. Ollie Downs, our Chief Technology, Product, and AI Officer. He's a pioneer in agentic decisioning systems and the architect behind Curinos' decision intelligence engine. Next up, we have Brandon Larson. He's our Executive Vice President and leads our entire advisory practice. Brandon needs no introduction. I think most of you have probably seen and met him in person. We also have Sarah Welch, Managing Director and the driving force behind Curinos' AI-powered consumer business, which includes consumer acquisition and consumer growth solutions. And then finally, Peter Serene. He's an expert in everything, Managing Director, and particularly an expert on banking industry, market dynamics, deposit strategy, and the evolving competitive field. So quite the powerhouse panel today, and you will hear why very, very quickly. But before we jump into the discussion, let me take a quick moment to ground us in who Curinos is, because it's central to the conversation we're having today. So we've been around for more than 2 decades. We've been a leading provider of actionable data and analytics solutions that help banks and financial institutions accelerate their journey towards deeper customer centricity, especially in deposits, lending, and customer growth. So what makes us unique is the scale, the depth, and the intelligence of the proprietary data we bring to the table. As you'll see on this page, our ecosystem spans about 8 trillion in deposit balances, more than 3 trillion in commercial deposit balances, about 3 trillion in mortgage origination information, 5 billion in treasury and account analysis management data. We have information on 94 million checking accounts, 20,000 bank branches. And because of all that depth and breadth of data, we're chosen to be partners with 46 of the top 50 US banks, 42 of the top US mortgage lenders, and 90% of the top US banks and credit unions, and frankly, more than 1,500 financial institutions globally. But my team reminds me, and I remind them back, data alone isn't the differentiator. So our benchmarking tools, our performance analytics, our optimization platforms operate on one simple premise. The insight is only as valuable when it leads to smarter decisions. Decisions about who to acquire, how to price, how to deepen relationships, and how to retain customers profitably. And that's why the theme of today's webinar is growing profitability when the markets won't sit still. And that's so tightly connected to our Curinos mission. So moving on, and we can dive into our session today. We believe very strongly that 2026 is shaping up to be the first AI native year of banking. That's a bold statement. We stand behind it. What this means for us, and I'm sure for many of you, that for the first time, banks will be competing not just on product, on rate or reach, but actually on decision intelligence. The ability to connect signals to outcomes, and then insights to actions, and customer relationships to enterprise value is going to be critical. But we also recognize at Curinos that this shift is happening against a backdrop of enormous complexity. So we've got rate volatility, we've got liquidity pressures, we've got a reshaped competitive landscape fueled by M&A. We've got digitally native challengers and non-bank competitors, and customers, frankly, whose expectations are moving faster than many of us want to react. So all of this makes 2026 a year where banks will need to use AI, not as an experiment, but as a core operating capability. So before I bring the panel in, we thought we'd make things interesting, and we actually were bold enough to do a poll. Hopefully the tech works. So we'd like to open a quick poll. On this page, you can see, how would you describe AI's role in your bank's customer growth strategy today? Option number 1, compliance, governance concerns, delaying adoption, meaning not yet adopted. Is it experimental? Are you exploring use cases and proving feasibility? Is it operational, meaning you're finding efficiency in service or fraud or back office or other parts of your bank? Or is it targeted, meaning it's deployed for specific customer decisions? Or is it central? Is it core to how we compete for customer relationships? I would love to see a quick response from the audience here before I pop our first question. All right, so that's an interesting view. So let's see, we've got 14%, meaning it's compliance, 58%. So overwhelmingly, the majority is it's experimental. We're all searching for exploring use cases and proving feasibility, and then 19% operational and service, fraud, and back office. I'm pleasantly surprised to see that it's central and targeted in certain areas as well. So very good, very interesting response. I'm sure we'll talk about this as we dig in today. A great foundation. So let's dive in. So first off, with Peter. Peter, maybe start with a quick overview of the macro environment. I know you've been tracking very closely. We hear a lot about rate volatility, sluggish deposit growth, frankly, which was a bit of a surprise for many of us. And then, of course, intensified competition. So given the backdrop for 26, what's your outlook for deposits and the biggest challenges banks will face? Peter?
Sure. So as we all know and live day to day, high quality, low cost deposit growth is the foundation of bank profitability. And as Sid alluded to, that has actually been quite challenging over the last year, with a total deposit market that's grown just a little over 3%. But underneath that, you've had some continued outperformance by the nationals, who have largely demonstrated that they can dial growth up or down almost at will, particularly in the more rate sensitive commercial and wealth segments. And then you've had significant share take from the non-traditional competitors, the direct banks, direct consumer banks, as well as some of the BaaS banks that are absorbing the balances that are flowing in through fintechs. On the other hand, regional and larger regional or super regional banks are losing ground, or have been in the last year. Now, we would like to say that our forecast models show a very different picture for 2026. Unfortunately, we cannot say that. As we often say, we don't sort of generate our own macroeconomic assumptions. We take those from sort of blue chip consensus, but we have models that apply those macroeconomic inputs to the flow through to bank deposits. And when we do that, we see another year of sort of low single-digit overall deposit growth, and at the same time, we see continuing trends that we'll talk more about towards some of these non-traditional competitors that have been outperforming. On the rate side, you see that there's a very wide difference between portfolio rates and acquisition rates. And customers continue to churn. They churn between a sort of existing competitors and new competitors, and they churn for life reasons. They move, for example. And the rate at which customers are acquired is much higher than the back book. So while banks have generally done a pretty good job of pricing down their more rate-sensitive interest-bearing deposits in the falling rate environment, there are some headwinds pushing against the overall progress that they can make. And the net impact of that has been that while NIM compression has sort of stabilized a bit, we haven't gotten the big expansions that we would have hoped for. When we look ahead to 26, I mentioned sort of the high-level forecast models. Just a little bit more color under that is a couple other things to consider. One is continued macroeconomic uncertainty. There's, as you've seen, particularly those following the Fed closely, there's this balance of labor market versus price stability that's not yet resolved. And the path, and you've got sort of higher levels of fragmentation on the FOMC than we've seen recently. We will, in all likelihood, almost near certainty, have a new Fed chairman in the beginning of the year. And so we'll see how that impacts the policy as well. And then, broadly from a sort of macro perspective, you've got a population that's only growing about 1%, and so it really is in order to outgrow that, you need to take share, not just kind of ride a tide up. And then finally, to kind of tie this back to AI, one of the things that's making it harder to pass through a lot of funding cost reductions and expand NIM is that AI is making it easier for our customers to compare and shop rates as well, and easier for them to move money. So put that all together, and it looks to be another very competitive year to grow and to acquire, grow, and retain deposits.
Yeah, Peter, I agree, and I think the through line in what you just said is, there's low growth, there's high competition, there's structurally rising expectations that make deposits a decisioning problem, right? And it's not just a product problem. And 2026 won't reward intuition, right? It will reward intelligence. So I want to turn to Brandon, and Brandon, let's build on that, right? So one of the biggest catalysts for customer churn and also opportunity is M&A. So with deal volume accelerating and now over 200 billion deposits effectively in play, how should banks think about playing the churn in an AI native environment, whether they're in a deal or simply competing near one? So Brandon, what are your thoughts?
Yeah, sure. So I think for starters, as you said, and we've seen a lot of M&A in the marketplace. We've had a number of deals announced, many of which will really start seeing activity more in 2026 as well, including some pretty sizable ones with PNC, Fifth Third, Huntington, Pinnacle, Synovus, but many, many more as well. A lot of these deals are really increasing the footprints of players into higher growth markets. So I think as Peter highlighted, you generally have less than 1% deposit or population growth in the country. In the Midwest, it's significantly lower. In the Southeast, it's significantly higher. And so what you've seen is a lot of expansion into some higher growth markets. What you'll see on the next page as well is that we have associated with these deals significant disruption in the customer base of the acquired institution. So the typical deal, we have about 11% attrition on the consumer customer base of the acquired institution between legal day one and 3 months post client day one, or the integration period, which is just massive. So as Sid, you talked about, that puts a lot of additional deposits in play, and a lot, particularly in the Southeast at the moment. As we think about the implications of that, there are really a couple. One, if you're going through M&A, if you are going through a big merger, ensure you're thinking about the customer disruption that you're going to experience or create. The largest drivers of that would be things like branch consolidations, product changes, integration challenges if people have their account numbers changed, or if they're going through a digital channel conversion, need to reset ACH. All of those are large disruptions that cause consumers and businesses to really experience disruption. And when we think about a world where you typically only have about 7% of customers switching their primary checking account on the consumer side, or even less than that on the business side, any of these disruptions that mean that somebody's going to have to take action in order to stay reduces the stickiness of their current relationship. And so it makes them much more likely to switch. If you're on the other side of that, so you're in markets that have significant M&A going on, you should be seeing it as an opportunity. So typically churn rates in banking are quite low, so that 5 to 7% I noted. As we look at disruptions to M&A, that really spikes those numbers and puts a lot more people in motion. The majority of that activity, as you think of those disruptions, again, tend to be coming right around conversion period. So typically right around client day one, you have a lot more disruption that's in the 3 months prior and the 3 months post, just as people are acclimating. So that provides an opportunity to drive up your acquisition. And I think that the same rules apply here, which is, in order to take advantage of the opportunity, whether that's on retaining as an acquiring institution or on capturing some of the churn, if you are a potential disruptor in the market who can benefit, is really thinking about the client experience first, being really targeted in terms of who you want to be going after, what the proposition is to them, and how you make sure that you're mitigating any disruption on the acquiring side, or that you're maximizing the disruption on the potential disruptor side. And then the last piece, Sid, to your question is, we do see that the impact of AI and really analytic and technology scale is beginning to become massive. And so the benefits of going through some of these mergers to get more and more scale, greater scale in terms of analytics, greater scale in terms of technology, the ability to apply and deploy modeling really becomes more and more attractive to both being able to grow from an acquisition side, but also to be able to ensure that you're getting the full depth of relationship on the customer side. And I think that that's something we've always seen in M&A, that you're getting additional scale. Historically, we talked about it as branch scale, that by acquiring, I'm getting more local density. That still is at play, but now the technology in terms of, or the scale in terms of technology, analytics, and the ability to drive up acquisition and deepening is really coming to light as well.
Right. And what I love about your framing is that M&A is no longer about balance sheet scale or footprint only, right? It's about decision scale. And the bigger players have the budgets to build AI engines internally, and others need to compete through precision and partnership, right? So it's a really well-made point. Peter, I want to turn back to you. Let's tie this together. You mentioned the explosion of non-bank competitors. Many of them are digitally native, AI native, and laser focused on specific customer needs. So what are the biggest things traditional banks need to understand about these competitors? And I guess more importantly, how can they use decision intelligence to compete? So bring that to life for us.
Sure. So today it seems everybody's a bank. And if you think of a bank-centric definition of that, you might say, well, but they don't have a charter. If you kind of turn that around and think about a customer-centric definition of where do I get paid? What app do I open to pay somebody? Where do I see where my money is? What app do I open if I need to borrow some money? That really expands the universe, and you've seen that across all customer segments. And something that we've talked about, the delamination of the wallet, that's maybe a technical term, but the sort of quick stat is if you look at the churning population today, over 50% of them have 4 or more primary checking relationships. Now, that might include Venmo or PayPal, right, in the customer's mind. But if you ask that question, how many checking relationships do you have? Over 50% have 4 or more. In 2019, that number was 7%. So we really are. Sid opened with this notion of the first AI native year. That's an indication of how dramatically customer attitudes and behaviors have changed in a very short period of time. Now, in terms of what that means, it touched on the fact that it's sort of across segments, whether it's in the mass consumer segment where Cash App now has 57 million US users. You've seen tremendous growth in the buy now, pay later segment, whether it's in mass affluent where you've seen huge growth from SoFi and Lending Club. And one that we're really interested in is Figure in the HELOC space. You can get an equity line not just approved, but funded in 5 to 7 days. And then if you think about small business, where Brex and Mercury are starting to break down some of the silos between the lending side and the deposit and payment side of small business relationships, the common thread is you have these kind of digitally native, segment-specific solutions. And if you put yourself in the shoes of a traditional bank competing against these, that's actually a pretty tall order, because banks are coming in with a certain amount of sort of legacy constraints, whether those be systems, technological, our loan platform or our card platform doesn't talk to our deposit platform, or whether they're financial. There's just such a big back book that it's really hard to think about doing something disruptive from a customer pricing standpoint. And so what that means is, maybe if you're the very largest banks, you can sort of meet these competitors head on and outspend them, outbuild them, out-innovate them. But if you're most of the banks in the US, you have to actually run a little bit of an end around on some of these competitors. And that means being smarter about how we approach these segments. And that's really where the decision intelligence angle comes in. And if we move to the next to the next page here, I want to show an example from some research that we did this year. There is a widely held belief that that the mass affluent segment is more profitable than the sort of mass consumer, mass market segment. And at surface value, that's true. But if you look at underneath the hood, if you find the right customers within those segments and really invest in the sorts of treatments that will grow those relationships, nurture and grow them over time. If you look at sort of the best slice of the mass market, they'll more than quintuple with you, their relationship with you over 5 years. Whereas on average, the mass affluent segment is going to run down a little bit over that same time period. So if you think about what those relationships look like, if you can be really targeted and meet those customers with the right offer, the right solution at the right time, and grow the right relationships, you can actually end up in a much more attractive place from an overall cost to acquire, grow, and retain.
Yeah, I think that's a critical point. One of my professors in in college used to talk about information asymmetry, right? So how do we get this knowledge about which customers create value and deploying intelligence to win and keep them, right? So the game isn't about having more customers. Appreciate that, Peter. So, hey, listen, I'm going to switch to my favorite topic here. It's a huge boardroom conversation. I get pinged on it all the time, and that's stablecoin. So, Peter, just very simply, can you bring this down to earth? What are the practical use cases, and how should banks, regardless of where they fall philosophically, ideologically, begin preparing intelligently for stablecoin?
Yeah, sure. So as you mentioned, this is one of the most frequent questions that we get, particularly at sort of the management team levels in banks. And the first place I would start with this is it's new, but it's no longer hypothetical. It is here, and there are, today the majority of stablecoin and tokenized deposits are still in kind of the crypto ecosystem. But there are real operating transactions taking place for commercial purposes in the market. So the future is now. The question then, though, becomes what does the future look like, and then what do we do about it very practically? Now, you'll see in the popular press alarming estimates, alarming if you're most traditional banks, of how big stablecoin might get. You see numbers like 2 trillion in deposits, 10% of GDP, et cetera. The way we think about the problem is that you have to assess how big this could be, and then critically what to do about it. You have to start by breaking down the problem into who are the customers, what are the use cases, and what are those deposits that are actually in play, and then critically, at the bank planning level, how does that align to my customers? So when we think about this in terms of segments, you could get more granular, but broadly speaking, you have big companies, small companies, wealthy individuals in the mass market. Why do we think about those differently? Well, the mass market, the value prop is really much more around the convenience of making and receiving payments, whereas for wealthy individuals, get very generous credit card rewards today and have larger balances. So the economics matter a little bit more for that segment. Smaller companies versus bigger companies, that's down to sort of the complexity of transactions, the volume of cross-border transactions, as well as the ability for those businesses to scale their own investments in building out their own treasury architecture to leverage stablecoins. Then once you have those segments, you can think about what are the use cases and why would somebody use them? So this really comes down to is it better than the alternative? Is it a better deal? Is it way more convenient? Is it more secure or not? And if you look at sort of other emerging payments, you see very different trajectories. Take Zelle and Venmo. That was way more convenient than cash or plugging in bank details or writing out a check, right? That solved a really important, a really valuable use case. Whereas if you look at something like real-time payments, which have started to increase a little bit, but the adoption was very slow on that. And that was because for most of the business use cases, they just weren't that much better than the existing alternatives. So we would really challenge everybody to think through to think through those questions. Now, when we make that real kind of in the middle of what we've put on the page here, there are some no-brainer use cases. International money movement, it's just better than the alternatives. Record-keeping intensive transactions, trade finance, escrow, legal settlements, et cetera. There are really compelling reasons, particularly when you layer in integration with smart contracts and agentic finance. Then you get down towards the bottom, and here's where it gets a little murkier, right? Are we going to use these for B2B daily payments? Are consumers going to go and pay at the retail store with a stablecoin wallet or not? At some point, where's the regulatory framework going to land on rewards? And is this going to be a place where people actually want to store value as opposed to value as a store of value versus just a payments mechanism? So those questions get a lot more uncertain. When we have run many of these scenarios, and we're working with banks to think through these in a lot more detail than we'll go into here. But I will say that our sort of mid-range scenario lands a little bit more conservative than some of what you see in the popular press. It's more in the closer to 1 trillion than 2 trillion. That said, there is uncertainty around those bottom boxes. I will land with just a couple of tactical sort of calls to action here in terms of what to do about it. The first is you really want to kind of run some tabletop exercises that you can communicate up to the board level around what it would look like for your bank if various of these scenarios were to play out. So go through the exercises on the left, see how does that apply to my customers, and then what would happen if option A happens versus option B. The second is just talk to everybody, right? This is an emerging field with a lot of players in the vendor space, bringing kind of technology companies, core providers, traditional banks all together. So the landscape is evolving every day. So really want to get as much information as possible. The third thing, which I will give some credit to our friends from FIS who participated in a summit that we hosted earlier this year for this one, but it's really good, is just run a transaction through your systems, right? Think about what you think the most likely use case is for your customers and see it through end to end to see what happens. And then 4 and 5 are really, once you've done that, this will be an issue where banks need to place some bets. And those bets may be we're all in, we're doing our own tokenized deposit. They may be we're selectively in, we're going to be segment focused, or they may be defensive. But you want to know kind of where you are and then go and execute against that plan. The last thing I will say here is all of this just makes the customer knowledge equation more complicated. So to tie it back to sort of our theme around decision intelligence, it raises the stakes as the way customers manage their finances get more complex. It raises the stakes for how well we know our customers and anticipate their needs.
Yeah, Peter, that conservative estimate of $1 to $2 trillion is still a pretty large number, right? And to me, the key takeaway is this stablecoin phenomena introduces complexity that banks cannot manage manually. I think you got to think about that differently, to your point. So let's move to our next speaker, Ollie. As I said earlier, Ollie's been building machine learning and AI models years before this became such a profound development. And he's advised hundreds of institutions on AI adoption. So Ollie, over to you. Just help us understand, what does the maturity curve look like now? And you probably have a really, really wide aperture from early pilots to true decision intelligence. And where do you see the most meaningful momentum?
We're in a really interesting situation, Sid, because we're in an industry which is the original analytical industry. Think about Elizabethan, Victorian, even back to biblical times, how sophisticated thinking in economics has sort of evolved. And although I think as an industry, we may be in banking, we may be sort of viewed as not that advanced or transformative digitally, I think the industry is in a great position to move very rapidly. In our own experience, year on year, this year in client forums, we've seen sort of AI experimentation reflect the survey we ran at the beginning of our conversation here, where, last year at our client forums, everyone was saying we're hung up in regulatory constraints and some restrictions internally. And now everyone's trying things and adopting things really quickly. So I think, firstly, I think the transition through this maturity curve is going to be much more rapid than we've seen perhaps in other parts of industry transformation, like the recent digital transformation. And secondly, I think it's a multifaceted thing where there are three things kind of evolving at the same time. There's this connection of data, about the customer, whether that customer is a consumer or an enterprise, the channels with which you interact with the customer, and you'll see that reflected here in some of our stages of maturity, and also the products and the portfolio of products that you think of sitting around that customer and orchestrate for that customer. A couple of places where there's some really interesting footholds and early innovation, and I think some of it's largely also driven by our industry's sort of view around efficiency, is you think about how rapidly digital customer service and chat has evolved. You know, in the industry now, recent surveys are suggesting about a third of customer inquiries are now handled by chatbots. And this year, with the latest generation of generative AI technologies, the majority of customers report that they're happiest interacting with a chatbot rather than a human agent, which is like quite a remarkable evolution. And at the same time, you know, there are big steps in operational efficiency and taking hard work in the back office out of workflows and automation that are very easy to measure within the bank. And also to create the scale that you need to deal with very large audiences of customers and interact with them in a way that shows that you know them as an individual. And in this, the most sophisticated experiences, and I'm sure some of you who responded to the questionnaire right up there in the highest levels of AI adoption, you're already acting on this, which is, you know, you really have 4 steps that you're able to achieve with your AI enabled capabilities, which is 1, to identify opportunities, 2, to decide which to act on for a given customer, actually orchestrate the action, and then learn from the outcomes of those actions, both about that individual and about your customer base as a whole, and be able to put that in a learning loop. And I know Sarah's going to talk to you about how we've embedded that in our products as we thought about our decision intelligence platform.
Yeah, and you know, there was a recent study that was a little alarming and I would say controversial. It was released by MIT. If any of you saw it, where 11.7% of jobs today could potentially be replaced by AI, which is frankly a very, very interesting data point. Now, it's based on statistical models, so that's the caveat. But we also believe at the same time, and it was also noted by several other experts, that agentic systems will find it hard to replace human judgment, right? I think that's where the partnership opportunity comes in, where these agentic systems amplify human judgment with transparency and control built in. And so with that, I want to turn it to Sarah. Sarah leads our consumer business. And Sarah, let's bring this into the Curinos world. You've helped architect how we integrate AI-powered capabilities into our platform. Can you share how banks are actually realizing value today, especially in acquisition or onboarding or deepening and growing the relationships?
Yeah, absolutely. I mean, I think, you know, anchoring back to some of the stats and things we heard from Brandon and Peter, 50% of consumer customers have 4+ checking relationships, M&A happening that is giving advantage to scale, fewer kind of customer switching, cost of acquisition doubling over the past 4 to 5 years. You know, it's rough out there. And I think, you know, it makes managing the end-to-end kind of customer life cycle from the sort of initial outreach all the way to the save desk much more important today. And we're definitely hearing about that from all of our customers. And to some extent, many banks are trying to manage all of this with technology stacks and maybe some operating models and structures that were designed maybe not quite in Elizabethan or biblical times, but close. And, you know, I think our work in decision intelligence really has been about bringing together what Ollie just mentioned, the ability to identify opportunity, just make decisions about what to do with a human in the loop, and then connect those kind of insights and decisions to activation systems in an automated way, but not just in a one-way direction, in a way that you can actually learn, and your system in effect is getting smarter over time. And we think about that by the integration of a few different capabilities into a single platform. The first is signals that ultimately reveal opportunity and where opportunity lies. And that comes from having a very rich and detailed contextual understanding of your customers, and being able to identify things like early signs of risk, early signs of growth, discretionary liquid opportunity that you could be doing or helping the customer optimize. And then making sense of those is one part of the equation. Acting intelligently on those signals is another part of the equation, right? So to do that, you also need to be able to understand what's happening around those customers in their markets with competitors, how trends and behaviors are shifting and adapting, and how your particular institution or any one particular institution is either gaining or receding in advantage. And then essentially being able to activate on that intelligence in a way that gets smarter over time. So every decision that you're making and every activation that you take is a learning opportunity for the entire system. And we have been thinking about bringing all of those three things together into a single platform, specifically focused on this category, which means that this is a glass box, not a black box, is how we think about it. Making sure that decisions and activation and learning are fully explainable and certainly within the guardrails of compliance. And so together, these capabilities form what we call a decision intelligence layer that understands where a customer is contextually in their financial journey and with you and with all of the optionality that they have. And then how do you align your pricing decisions, marketing decisions, experience decisions in order to find the right balance of value for helping customers grow and keep the institution healthy.
Yeah, and what's interesting about that is we also operate in a world of compliance and regulatory guidelines and data privacy, right? Like you can't tell someone who is eager to buy their home and say, hey, we denied your mortgage, it was through an AI model, and trust us, right? You can't do that. Yeah. And there's also this concept of just being fair at a human level. So I guess before we wrap, I want to address that question on every executive's mind. Like, how do banks adopt AI at scale, but safely, compliantly, and what guardrails are required? And talk to us about that critical differentiation of how you do that inside of a bank.
And Sid, I would say it's probably why we as an industry have been slow to get going and now can move very, very quickly, in the sense that sort of if you think of the first wave of technologies, they were very consumer oriented and not FI native solutions. And that really caused initially an inability to buy technology and a pressure for institutions to have to build, which favors, of course, the very largest institutions. And now we have solutions being built that are absolutely FI native by default and have compliance, auditability, and guardrails embedded in them from the start. Sarah, I know you want to share some thoughts on this.
Always. I mean, I think that you sort of said it, the sort of first order here is to have the guardrails designed first, not bolted on kind of after the fact. And I think that's really the central difference between kind of generalized intelligence offerings versus intelligence offerings that are fit for the regulated industry that we play in. And part of that is having kind of interfaces that allow humans to define those guardrails directly into decisioning platforms. Another part of it is, as we think about things like reinforcement learning, right, which could be black boxes, enabling those to be fully auditable so that if you're ever tapped on the shoulder and said, why did Sarah get that decision and Ollie get that decision, you can sort of crack open the code, if you will, that drove the decision for Sarah and for Ollie, and discuss that with internal compliance teams, regulators, and the like. And then the last piece is continuously monitoring for, for any unintended bias as well, just as a fundamental part of an operating rhythm around the application of this kind of intelligence.
That makes sense. All right, so let's close with a forward-looking lens. And in one sentence each, what is the number one theme that'll propel your clients towards success in 2026 and beyond, right? So maybe we can go around the horn and have everyone chime in. Let's start with Ollie.
Sid, you hit on it a little earlier for me, which is this combination of the human and the machine, and how you combine the human intelligence in your institution with artificial intelligence, and allow yourself to look across both data, decisioning, governance, and execution, with the customer at the center of that and optimizing their experience.
Sarah?
I think for me, as I look across the just hyper competitive landscape, I would say that success is going to come from being really precise in how you identify growth opportunities and how quickly you can activate on those. And I think the institutions that are really able to quickly identify where pockets of opportunity are within their portfolios, within their markets, and then eliminate the distance between that any insight on opportunity and activating on it and learning from it are the ones that are going to pull farther ahead faster.
Thank you, Sarah. Brandon?
Yeah, I would just build on Sarah's precision comment and maybe emphasize intentionality. I think that being very intentional, whether it's on the prospect side or with our existing customer base, on specifically who you want to go after and what the right message and the economics are that will drive that person. I think particularly on the prospect side, you can consider that the typical bank would have about 30% of acquisition driven by marketing, meaning that 70% of the people that I acquire are just naturally walking in the door based on my branch location or my brand or personal connections. But there's 30% that I'm actually doing something proactively to drive to walk through the door. And I think there's not enough intentionality across the industry on who am I targeting, why do I feel confident that they're going to open with me, and what's going to make sure that I bring the whole relationship of that customer once they do come through the door. And so that intentionality around going after the right people with the right offer.
Thanks, Brandon. Peter?
I'll bring that down to the very bottom of the funnel. So if we think about insight and decision intelligence and intentionality, that ultimately has to translate to a treatment, an offer that we make to a customer, a piece of marketing that we put in front of the customer, a person who we put in front of the customer through our distribution channels. So I think making sure that we keep those things as close together rather than having sort of innovation off to the side and practical banking over here. They are in 26 and going forward, they have to be one and the same.
Thanks, Peter. All right, with that said, we will now take questions. In fact, there have been some incoming questions our way. So if you can go ahead into that Q&A box, type in your questions, we'd be happy to address them. The questions that we have that came in so far are, Brandon, I'll start with you. You've talked about the importance of both acquisition and customer deepening. Which is more important and should be the first priority for advanced analytics?
Yeah, you're asking me to choose between my children, and of the three, there are two logical answers there. But I think overall, the reality is, from a customer deepening standpoint, making sure that I get the full value out of the customers that are coming through the door is really critical, because it drives both the acquisition and customer economics. And so if I were only to start with one spot, I would be making sure that I get the full retention, customer depth of relationship that I can for all those coming through the door. But what that then allows me to do is to scale up the acquisition. So as the customer economics really are advantaged, it gives me the ability to rebalance that customer acquisition cost versus customer value equation, so that I can actually flex up the acquisition side more aggressively. So I know that's a little bit of a cheating answer in that I said both, but I am saying I would start on the customer value side, because without that, your acquisition just isn't going to drive the value it needs to in order to justify the economics.
Got it. By the way, if anyone on the rest of the panel wants to chime in, feel free to do so. Going once. All right, next question is, what do you see as the highest return AI investments banks can make right now? Who wants to take that one? Maybe start with Sarah.
Yeah, it's a great question. There are lots of opportunities. I think if we're thinking about going beyond POC to really high impact application, I do think that decision intelligence for kind of activating customer decisioning across either pricing and marketing and experiences, or kind of one of those domains, is a very high return activity. When we have seen that applied on any side of that acquisition customer equation, we have seen very high impact outcomes. So on the acquisition side, that ability to identify the highest value customer out in a prospect world and go target them with precision and bring them down funnels effectively and get them seated as primary customers, that has a significant impact. And the ability, as Brandon was talking about, to actually maximize the value of each customer you already have, whether that's through deposit acquisition or balance expansion, or deepening the relationship across the full portfolio of offerings that you have, that can be very, very substantial.
That's great. Thank you, Sarah. All right, next question. How can mid-sized regional banks compete given the scale of big bank and big tech AI investments? Peter, do you want to take that one?
Sure. I mean, I think there are really two things that I would highlight. The first is the importance of having a really clear, distinctive value proposition and segmentation strategy that you can then translate into targeted investments in the right products and sales force and marketing for your segments. The other is finding the right partners. There are, as these technologies come out, it costs a huge amount of money to build them yourselves, which the largest banks are trying to do in addition to partnering. But very quickly, I think it'll be a matter of kind of picking your spots and then picking who you're going to ride alongside with to make that happen.
Great. Thanks, Peter. Brandon, this one for you. Do you expect mega mergers in 2026? I think I know what you're going to say, but let's hear it.
So I think in general, we tend to not comment on what could be, but I think that we will continue to see more and more banks looking to get scale in the marketplace. So I think we expect more M&A activity to continue as a whole, and I would expect the size of those mergers to continue to stay large and potentially increase in size. But the need to have scale in the industry is getting more and more critical as I look to drive outsized growth as well. It also does necessitate having more markets that I'm competing in, being able to drive that growth, which is what you're seeing both with many of the regional mergers that have taken place, and then honestly the national bank de novo strategies have been focused on the same thing, is growing in new markets that they weren't present in previously, which is really the way that they can help drive that outsized growth.
All right, we have one final question, and Ollie, this one's going to you. It's a tricky one. With AI being so notoriously incorrect, doesn't it a situation where banks that decide to go all in on AI face significant risk up to and including failing? And my favorite question, and I'll add to top of that, is like, does Moore's law still hold in today's world where AI is moving by the day, by the hour, and by the week, right? It's just incredible how these models are becoming more powerful, and we saw Gemini 3 be one of the most powerful human intelligence platforms thus far. But Ollie, over to you. We have 2 minutes, and then
2 minutes. And Eric, thanks for posting this question online. I was intrigued and hoped to get to answer it. So I would say we talked about the human-machine boundary here. I would say over a 25-year career building data science, machine learning, AI, and now generative AI solutions. The key I found to driving successful businesses leveraging these types of capabilities is where you find that right set of points where the human is in the loop, and you define systems that have natural guardrails to them. So it's not open-ended exploration and unstructured conversation and unguided or unfactual reasoning. You really have a bounding box within which you're allowing the AI capability to play. And then you set your tenets around the type of solutions and experiences you're willing to build. As we've thought about our decision intelligence platform at Curinos, our fundamental tenets have been that data will always be factual data. Reasoning will always be driven by our deterministic mathematical algorithms, not by AI made up math. And that there will always be humans in the loop to set the guardrails and to see and audit the outcomes and the decision-making process. And I think, the path to failure is just being willy-nilly and scattered and not being principled in how you either acquire or build these technologies, and really being focused on what does a successful outcome look like for your customer and for the bank.
Got it. Agree with that, Ollie. All right, I know we're at the top of the hour, and we'd like to bring this webinar to a close. I think what we heard in summary was that the year ahead demands more than just good instincts. It demands intelligent, connected decisions across our customer lifecycle. And with the right decision intelligence capabilities, I think every moment becomes a moment to grow. So again, thank you for joining us. and we look forward to partnering with you in 2026. And please don't hesitate to reach out to your Curinos counterpart if you have any further questions. Take care.